Today, I'm going to share the top 7 dividend stocks to watch after reporting earnings late this week. These are all high-quality companies with a history of dividend growth and yields between 2 and 5%. Earnings news, good or bad, can often lead to big stock price reactions. For example, Hershey beat expectations and the stock was up over 4%. Philip Morris International was up nearly 11%. TROW price was down 5%. Microchip technology is down 7%, and reliable dividend growers like Snap-on are down nearly 5%. And that's just the start. Today I'm going to analyze the good and bad news from these earnings reports and explain which stocks you should avoid and which are potential opportunities to watch. With that said, let's dive into the analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Dividend Data is your #1 source for all things dividend stocks, and the earnings of those stocks have a big impact on your investments. We are still in peak earnings season, so I track that using our official partner, Earnings Hub. You can find that linked on the sidebar of dividenddata.com, and if you sign up using our link, you can get unlimited notifications on their Pro plan for just $1 for the first month. Or you can save 25% for the year. That's through the Dividend Data link, which you can find in the description and pinned comment of the video. Let's start with Hershey, ticker symbol HSY. That company is up 4.4% after reporting earnings, which is definitely a little bit of a surprise because earlier this week, MDLZ was down big after their earnings. That and the fear of rising cocoa prices made people think that Hershey stock would suffer even more. But Hershey actually surprised to the upside, beating revenue expectations by 1.69%, and earnings per share expectations by 13%. So despite poor expectations for 2025, Hershey stock actually did well this quarter. So let's break down the good and bad news from Hershey earnings. To do so, I'm going to be using the AI analyst over on dividenddata.com. I find this to be the best way for me to keep up with earnings news. Since it can often be quite overwhelming to stay up to date on all your stocks, I go straight to asking for a summary of the quarter and earnings call so I can get my initial impressions right away. And if we look at Hershey, they definitely outperformed in this quarter. For Q4 2024, net sales increased 8.7% year over year, and that was driven by organic growth of 9%. Adjusted earnings per share grew 33% year over year for the quarter, and they saw the strongest growth in their smaller salty snacks segment. All right, so there was financial good news, but what was the more holistic business good news? One, they're seeing progress in reducing cost, and two, they're seeing new innovative products in their sweet portfolio with the Shackalicious gummies and Valley Rancher. This wasn't mentioned, but I know they also just completed their acquisition of Sour Strips, which is a very good company. I think that will be a big winner for Hershey in the decades to come. But guys, let's remember that the market was very negative on Hershey stock going into the quarter. And the reasons why are that the cocoa prices are horrible right now. They are up 135% year over year. And in Hershey's earnings, they mentioned that they anticipate significant gross margin pressure in 2025 due to elevated cocoa cost. And this is primarily a chocolate company, so cocoa is a core cost in most of their products. They also mentioned they're seeing market share decline in the everyday chocolate market. I'm not surprised by that because we do have new entrants into the chocolate market in the US, most notably Feastables from Mr. Beast. That is going to be a gigantic company over the long term and a threat to businesses like Hershey. But we also have to be fair that Hershey is the much larger company with a diversified portfolio of high-quality brands. But also Reese's, which in my opinion is the most valuable candy brand in the world. I might be a little biased there because it's my personal favorite. And if you live in the US, you recognize most of these brands. They have a very diversified product portfolio. But again, I want to re-emphasize that Hershey is expected to have a very poor 2025 on a relative basis. They're expecting net sales growth of around 2%, and that's expected to be driven by net price realization, meaning price increases. So organic growth will not be good this year. They're also expecting earnings per share to decline significantly in the full year 2025 due to higher cocoa prices. Chocolate is their core business, and that will hurt margins. For context, 81% of their annual revenue comes from that chocolate business. But let's take a big picture look at Hershey stock. The company has sold off massively and is a long-term earnings and dividend grower. And to give some context of how big that sell-off is, they're currently seeing a drawdown of 45% from all-time highs. But this sell-off actually makes Hershey stock a pretty interesting value. Based on earnings over their trailing 12 months, their PE ratio is 17.5. They currently have a 3.6% dividend yield even after going up today. And for context, that's basically one of the highest dividend yields over the past 5 years, and one of the highest all-time for Hershey stock outside of during the Great Financial Crisis. So as this cocoa inflation continues, there may be a good buying opportunity for Hershey. Over the long term, this has been a great business. Revenue per share is growing at an 8% 5-year compound annual growth rate. Free cash flow per share is growing at a 7.3% 10-year compound annual growth rate. And historically, this has been a really high-quality dividend growth stock. They increase every year on an annual basis and recently had 2 very large increases within 1 year. The current annual dividend is $5.48, which, as I mentioned, is a 3.6% dividend yield. It's a quarterly dividend payer, and the 10-year compound annual growth rate of the dividend is 9.86%. And as I mentioned, they had 2 15% increases in the span of 2 quarters. And right as I'm recording this video, they actually just announced another dividend, and it is not an increase. This matches up with something I've been saying lately, in that Hershey stock may slow down dividend growth due to its poor 2025 performance. Also, I do think they got ahead of themselves with those 2 15% increases. So they may cool for a while, but it's important to remember this is still a very sustainable dividend payment. The payout ratio based on free cash flow is 57% and 47% based on net income. So Hershey is definitely a stock to watch in 2025 if you're a long-term dividend growth investor. And even if you're a value investor, it's sold off quite a bit. Using the discount cash flow calculator in the AI analyst, it shows a $210 intrinsic value per share. That implies a lot of upside from the current price. By the way, that's using perpetuity with an assumption of a 2.5% terminal growth rate. If you want to play around with this calculator, it's all available on dividenddata.com. You can look up any stock and just type in discount cash flow, and you'll get a detailed breakdown. If you scroll down, you can get access to this calculator. Stock number 2 is Philip Morris International, ticker symbol PM. They were up 10.95% after reporting earnings. They beat revenue expectations by 2.82% and EPS expectations by 3.33%. This beat sent the stock price up to all-time highs. But let's look a little bit more behind that earnings news. So yeah, they crushed it. They had strong growth in all their key business categories, and especially in their 2 main growth businesses. They continued their international expansion of IQOS, but the big growth business here with Philip Morris is Zyn. This is the nicotine pouch that has just gone crazy popular. And since Philip Morris International doesn't have much of a US presence, this is their #1 US product. They saw shipment volumes of Zyn grow 51% in 2024. This is a huge growth business, and they definitely have a dominant position as the #1 brand in the nicotine pouch space. But nicotine pouches in general are a very big growth business. Their combustible cigarette business saw double-digit gross profit growth in Q4, around 7% organic growth for the full year. And their smoke-free business is now up to 40% of total net revenues, around 42% of adjusted gross profit. And it's really for that reason why Philip Morris International trades at a much higher valuation compared to something like Altria Group. Altria still is much more dominant in cigarettes, and they had the failed Juul investment, which kind of hurt them in the smoke-free category. So they are much earlier along in the process of developing their smoke-free business. So yeah, Philip Morris International had a really good quarter, and for 2025, they gave outlook of organic net revenue growth of 6 to 8% and double-digit adjusted earnings per share income and EPS growth. So this company is doing very well right now. Those higher growth rates also help command a higher valuation, but that also gives you a lower dividend yield. The current dividend yield is 3.72%, which compared to something like Altria, which is usually in the 8% dividend yield range, and I bought that in the 10%. Philip Morris International is a long-term dividend growth stock. The 10-year compound annual growth rate of the dividend is 3%. It's a quarterly payer. Their most recent dividend increase was 3.85%, and given the recent good performance, this growth may accelerate in the future. But the counter argument to that is they have some catching up to do when it comes to their payout ratio. In fiscal 2023, they had a 100% payout ratio, which they likely want to improve. But I would not say Philip Morris International has any risk of a dividend cut in the near future. Stock number 3 I'm going to share today is Snap-on Incorporated, ticker symbol SNA. This is another long-term dividend growth stock, and you can see they've had fantastic earnings growth over really the past 15 years, and the stock price has followed suit. However, they are down 4.5% after reporting earnings. They missed on revenue expectations by 0.08% and beat on EPS estimates by 0.63%. And if we look at performance in that quarter, their revenue grew 4% year over year, and earnings per share grew, but only at like 1.4% year over year. The main positive from the quarter is that they saw improved operating margins. That was in the Commercial and Industrial Group and Repair and Systems Information Group. They saw record profitability in both of those segments. However, the main negative was that their Tools Group segment decreased 1.4% in organic sales during the quarter. Also, their financial services business declined. And if we get a breakdown of their business by segment, you can see that the Tools Group is their largest business at $500 million of quarterly revenue. So it is their largest business segment, which is declining, so that can be a big negative. That said, the company did reaffirm guidance for 2025 where they are expecting growth. And Snap-on overall is definitely underrated as a high-quality dividend growth stock. You don't hear this one talked about that much. The current dividend yield is 2.52%. It trades at a reasonable valuation, and the payout ratio is actually very low at Snap-on. I'm talking about 35% based on EPS and 33% based on free cash flow. And this thing is a dividend growth machine. The 10-year compound annual growth rate of the dividend is 14.98%. The most recent dividend increase was 15%. And really, the past 4 dividend increases have all been around 15%. So it's pretty rare to actually find a stock with a 2.5% yield and 15% dividend growth. So if you don't already, you should definitely add this stock to your watch list. Stock number 4 is Microchip Technology, ticker symbol MCHP. This company sold off nearly 7% after reporting earnings. This decline isn't reflected yet as that was after hours, but that will boost the dividend yield to 3.67% tomorrow. And prior to looking at this today, I was actually unaware that Microchip Technologies was a dividend growth stock. In fact, they increase it every single quarter. Although that has slowed down massively, which makes sense because their earnings have fallen off a cliff in the past year. This company missed bad on their earnings, missing revenue by 2.29% and earnings per share by 28.5%. I'm not as much of an expert on this company's business model compared to some of the other ones I'm sharing today, but I'll still give you a summary of the earnings news to give you an idea of why the stock is down, and then you can explore to see if you would be interested in buying. So the big problem here is that they have a lot of excess inventory, and they attribute that to a large inventory correction following a post-COVID super cycle. I'm going to keep this one brief because I don't know much about Microchip Technologies, but if you want to dive into it, I would suggest looking through the different product categories and try and get an idea of the demand in the coming years for their products. For stock number 5, I'm going to share the Walt Disney Company, ticker symbol DIS. This is a company I have long talked about on the channel, and they are finally in the midst of their earnings recovery and are likely going to hit all-time highs very soon. But the market did not like something about Disney's results, and they were down around 4% after earnings. And if you look at the financial results, it may be kind of difficult to figure out why, because they beat on revenue expectations by 0.5% and earnings per share expectations by 23%. So what were the positives? They had the top 3 movies of 2024. They're seeing a lot of growth in streaming profitability, as that's officially become a profitable growth business for them. They're about to do a password sharing crackdown in 2025, which should re-accelerate subscriber growth. The negatives for the quarter were that they saw a decrease in Disney Plus subscribers, but an increase in Disney Plus Hulu subscribers. The other main negative I found is that they increased capital expenditures massively in the quarter. It went from $1.2 billion to $2.4 billion. So that actually caused free cash flow to decline 17% year over year. But the management says that they are strategically reinvesting into growth businesses for the future, most notably in their parks where they see very good returns. And I'm not really worried about this at all because their cash from operations increased 47% year over year. And the big reason why is they've stopped losing billions of dollars in their streaming services. They've turned that into a profitable business, and that is set to grow into the future. Disney's feeling pretty good about their upcoming financial performance. In fact, they were getting questions on their earnings calls asking if they would raise their guidance, which was already pretty high. They previously gave out guidance for the coming years, not just 2025. And Disney said that they are open to exceeding their financial guidance if business momentum justifies it. And if we look at Disney's stock, their analyst projections for the upcoming years are pretty high. They're expected to have double-digit earnings per share growth all the way through fiscal 2029. And given this, their 2029 PE ratio based on today's prices is 12.8. So Disney stock has been a terrible investment for much of the past decade, but in my opinion, it seems pretty logical that the stock is set up to do well in the future. The valuation is finally reasonable, streaming is profitable, and they have a clear growth strategy going into the future. They also finally brought their dividend payment back, and that is set for long-term dividend growth from this smaller base. Stock number 6 is the TROW price group, ticker symbol TROW. They had a 5% sell-off after reporting earnings on Wednesday, and this one seemed a little deserved as they missed on expectations of revenue and earnings per share. That was a 2.4% miss on revenue and 3.64% miss on EPS. But overall, the earnings decline has stopped at T. Rowe Price, and they seem to be on a path for continued growth from here. And the stock itself is now trading at a very low valuation and a 4.45% dividend yield. While they missed their estimates, their financial performance was actually pretty good on a year-over-year basis. Revenue was up 9.8% year-over-year. GAAP EPS was up 17.9% year-over-year for the quarter. And adjusted earnings per share for the quarter was up 23% year-over-year. They also saw their net outflows of assets under management improve from the prior year. That went from $43.2 billion to $19.3 billion. And in the good news, they actually saw positive net flows in various categories. They also saw their ETF business grow, which will be a very important strategic thing for them long term. They saw $4.7 billion of net inflows for their ETF business. That was during the full fiscal year 2024. Bad news was that they saw underperformance in a lot of their equity strategies and outflows in some of their other segments. The company gave outlook for fiscal 2025, where they're expecting further reductions in net outflows, and this stock probably won't start trading at a higher multiple until they start seeing net inflows. They also said they remain committed to returning capital to stockholders, and this is a company which is a long-term dividend growth stock. The 10-year compound annual growth rate of the dividend is 10.92%. However, this has slowed coming out of 2022, with the most recent increases being 1.64% and 1.67%. And that's because they saw this big decline in earnings coming out of 2021. However, they're now on the positive upswing back towards those highs. But the opportunity here is that the stock price is still depressed at these low levels. The dividend payment is sustainable. This company does generate a lot of free cash flow, and it has a fantastic balance sheet with over $10.3 billion of shareholder equity. They have negative $2.6 billion of net debt. So this company is in a strong position to return capital to shareholders with a growing dividend and share repurchases. In fact, this is a company which has a history of doing large special dividends whenever they build up a large cash cushion. The last time they did this was June 2021. And you can see the company just boomed during that run. So T. Rowe Price right now is, in my opinion, a pretty good dividend growth stock you can get at a low valuation. That said, there are a few things that I like, and then other things that are kind of ongoing risks for the company. What I like is that their business is pretty simple in that it's just fees from their assets under management, and they just manage people's investments. And theoretically, as long as they can keep clients and grow that money, then their assets under management will grow, and therefore the money they get from fees will continue to grow. And that fees is a very scalable, high margin business, which is why over the past 100 years, T. Rowe Price has done so great. However, the problem with T. Rowe Price is that they are very heavy in mutual funds, and those have higher fees compared to these passive ETFs, which are becoming very popular. So they are seeing some pressure on fees, and that will likely continue to decline over the long term. The opportunity is then they have to grow other business segments outside of mutual funds, most notably ETFs. Their ETFs have $8 billion in assets under management right now, but they also have much lower fees than their mutual fund business. So I don't know how T. Rowe Price's investing will go necessarily, but I think T. Rowe Price as a business will probably do pretty well. I would say the downside risk is pretty low at current prices. For stock number 7, I have Yum Brands, ticker symbol YUM. This company boomed to nearly 10% after reporting earnings today. They beat analyst estimates for both revenue and earnings per share, but by less than 1%. And if we look at how they did overall, revenue was up 6.9% year over year, and earnings per share is actually down 8.5% year over year. And if you don't own this company, they own a lot of different restaurant brands, most notably Taco Bell and KFC. And that was on the positive side. Taco Bell apparently saw sales grow 5% year over year, outpacing the industry by 5 percentage points. Oh, they also own Pizza Hut. I forgot that. KFC saw same-store sales decline 2% year over year. The company also had pretty good outlook. They're expecting an 8% year-over-year increase in operating profit for fiscal 2025. They also saw digital sales at $9 billion, now over 15% of total system sales, and that's a core focus for the company. But in my opinion, that didn't really tell the story of why it was up 10% that much, so I went and asked for more positive news of what happened. And what I saw is that they're doing an international expansion for KFC. They're expected to add 2,000 net new units for the second consecutive year. They also announced a 6% dividend increase, which is pretty positive. And historically, Yum Brands is a dividend growth stock. The company has grown their dividend at an 8.5% 10-year compound annual growth rate. Their two prior increases were 10.7% and 6.14%. And it is pretty sustainable with a 51% payout ratio based on free cash flow and 42% based on net income. Personally, I'm not super bullish on Yum Brands, but it looks like they did have a positive earnings report. So those are the top 7 dividend stocks to watch after reporting earnings this week. If you want to use the stock research tool I show throughout the video, all of this is available at dividenddata.com. The link will be in the description and pinned comment of the video. And if it helps you find just one better stock, then it more than pays for itself. Thanks for watching, and I'll see you in the next video.